Have you ever found yourself maybe staring at your screen, could be your banking app or an investment statement, and just felt that kind of familiar pang of, I really should understand this better?
Oh, absolutely. Or maybe you're just grappling with the sheer volume of financial decisions landing in your lap every day.
Exactly. From trying to make sense of a credit card statement to, planning for something as far off as retirement.
It often feels less like making a choice and more like, well, navigating a tidal wave of jargon and really complex options.
Well, welcome to the deep dive. Our mission here is to take your sources, peel back all those layers, and really pull out those essential nuggets of knowledge.
And the surprising insights that can help you get well-informed, fast, without feeling totally overwhelmed.
Today, we're diving headfirst into a topic that, let's face it, touches every single one of us, no matter where you are in your financial journey: financial literacy.
And specifically, its profound and sometimes really surprising impact on your financial well-being and even, the broader economy.
For this deep dive, we've got a really fascinating editorial as our main guide. It's from the very first issue of the Journal of Financial Literacy and Wellbeing.
Yeah, penned by two incredible minds in this field, Annamaria Lusardi and Flore-Anne.
And this piece, it's just a masterclass in bringing together tons of critical research from all over the world. Everything from, say, the real-world impact of teaching finance in schools
to how we can get better at navigating complex modern things like, crypto assets.
So our mission today is to really unpack why financial literacy is so crucial right now.
Especially when you look at the global data showing that levels of this vital knowledge are, frankly, remarkably low.
We're going to explore how a deeper understanding of these concepts directly influences your ability to make smart, informed decisions, build genuine financial resilience against, life's curveballs.
And how, when you add it all up, it even shapes the broader economic landscape we all live in.
Yeah, expect some surprising facts and hopefully some actionable insights drawn straight from global surveys and some cutting-edge academic research.
Sounds good.
Okay, so let's start right at the beginning. We hear the term financial literacy thrown around quite a bit.
All the time.
But when I hear it, honestly, I immediately think of just knowing facts, like what's an interest rate or how does a savings account work?
Right, the basics.
But your sources, and specifically the OECD PISA experts, they seem to suggest it's much, much more than just that. What's missing from that kind of basic understanding?
That's a really excellent place to start, because what's often missing is the purpose and the impact.
Okay.
The OECD PISA expert definition is, I think, incredibly insightful because it really goes beyond just knowing things.
Yeah.
It defines financial literacy as, and I'll quote it loosely here, knowledge and understanding of financial concepts and risks. Okay, that's the knowing part.
Right.
As well as the skills and attitudes to apply such knowledge and understanding in order to make effective decisions.
Right, the application.
Across a range of financial contexts to improve the financial well-being of individuals and society and to enable participation in economic life.
Wow, okay, that is comprehensive. It covers a lot more ground than just, balancing a checkbook or knowing what APR means.
Definitely.
So what are the truly innovative parts of that definition? The bits that really expand how we should think about this?
Well, there are four key aspects that really stand out and broaden our perspective. First, as you picked up on, it emphasizes purpose.
Right.
It's not about just collecting knowledge for its own sake. It's about using that knowledge to make effective decisions.
There's action, not just information.
Precisely. Think about it. You might know what a budget is, theoretically, but can you actually create one and stick to it in a way that genuinely improves your financial life? That's the real difference.
That makes perfect sense.
Yeah.
Okay, what's the second aspect?
The second is its aim to improve financial well-being. This is much broader than just focusing on one single positive behavior like, say, saving more or avoiding debt. It really encompasses your overall financial health, your security, your peace of mind. So, for example, it's not just about having a retirement account, but feeling confident that it's actually funded properly for your future needs.
Or knowing you have an emergency fund that truly offers a cushion when the car breaks down or something unexpected happens.
Exactly that. It's a more holistic view of financial health, almost like overall wellness, but specifically for your money.
I like that analogy. Holistic financial health. Okay, number 3.
Third, its effects aren't just confined to individuals. This is really important.
How so?
Well, your financial decisions, my financial decisions, when you aggregate them across a whole population, they can have ripple effects. They can contribute to, or unfortunately detract from, collective economic stability.
like thinking about the big financial crises.
Exactly. They often have roots in widespread poor financial decisions made by many individuals. So improving financial literacy isn't just a personal gain, it's actually a societal one.
Okay, that broadens the scope significantly. And the fourth aspect.
And fourth, it highlights that financial literacy, much like, say, core academic subjects like reading or science, enables full participation in economic life.
Meaning?
Meaning, without it, navigating things like digital banking, online investing, or even just understanding your payslip properly becomes a significant barrier.
Okay.
It's basically a foundational skill for just engaging with the modern world and its economy.
And when you connect that really robust definition to our current financial landscape,
Yeah.
wow, the urgency of the skill becomes even clearer.
Absolutely.
I mean, I'm thinking about the huge changes we've seen just in the last few decades. The dramatic shifts in pension systems, for one.
Definitely. Moving from defined benefit, where the employer took most of the risk, to defined contribution, like 401ks, where the responsibility falls squarely on the individual.
Right. And then there's the sudden emergence of incredibly complex financial instruments, things that just didn't even exist a generation ago.
That's absolutely spot on. The editorial really underscores how critical this is. Think about the increasing complexity and just the sheer volume of financial products out there now.
From elaborate derivatives to entirely new things like cryptocurrencies.
Exactly. And then you add persistent inflation eating away at purchasing power
Oh, yes.
and increased global risks, things like geopolitical conflicts, the war in Ukraine, or the pervasive challenges of climate change, which can disrupt markets and economies unpredictably.
So all these factors together just amplify the urgent need for strong financial knowledge and skills.
It's no longer just a nice to have, is it? It's really a fundamental requirement for building individual resilience and improving overall well-being in a world that's changing incredibly fast.
Okay, so despite this critical and clearly growing need, it feels like we keep hearing that financial literacy levels are actually, well, remarkably low. Is that truly the global reality, even in countries we think of as financially advanced?
It is, unfortunately. It's a widespread reality. The sources are quite blunt about it, stating that levels are indeed remarkably low globally.
Wow.
And crucially, this isn't just an issue in developing economies where maybe access to education is limited. It's demonstrably true even in countries with highly developed financial markets.
Places where people are actively using sophisticated financial tools every single day.
Places where you'd almost expect literacy to be higher out of sheer necessity.
That's genuinely surprising to me. I mean, intuitively, you'd think that in nations with complex financial systems and widespread access to banks, investing, people would naturally become more savvy.
You would think so.
Why isn't that happening? Is it just a lack of formal education, or are there maybe deeper systemic reasons the research points to?
That's a really crucial question. You might expect this natural evolution towards higher literacy, but the data just tells a different story. The latest OECD Adult Financial Literacy Survey, for instance, found alarmingly low levels across many G7 and G20 countries, big developed economies. And a broader global survey confirms this pattern. It shows only a handful of nations really rank high on even the most basic measures.
So why? What are the reasons?
Well, it seems to be multifaceted. Financial innovation is happening so fast that new products often outpace public understanding.
Right, things change before people catch up.
Exactly. Financial education hasn't consistently been part of core school curricula until quite recently in many places. And often, let's be honest, people learn by trial and error, which can be a very expensive way to gain financial knowledge.
Yeah, painful lessons.
So it really points to a systemic challenge, not just an individual failing.
And it seems this problem isn't evenly distributed either, is it? Are there specific demographic groups where financial illiteracy is particularly, well, acute, creating even bigger challenges for them?
Yes, this is a really critical finding that the research highlights again and again. Financial illiteracy is described as particularly acute among subgroups that are already financially vulnerable.
Such as?
Consistently, this includes women, individuals with low income, and those with lower levels of educational attainment.
So the people who can least afford to make mistakes.
Precisely. These groups often face compounded challenges, maybe less access to resources, less disposable income, systemic barriers, and a lack of financial literacy can just exacerbate their vulnerability. It creates a cycle that's incredibly difficult to break.
It's really an issue of equity then, as much as education.
Absolutely. It potentially widens existing inequalities.
And what about the next generation? Are our young people who are going to inherit these increasingly complex financial systems, are they any better prepared than their parents?
Unfortunately, the outlook there is also pretty concerning. Financial literacy is notably low among high school students, too.
Oh, no.
Which suggests that the next generation is often, and the source uses this word, ill-equipped to navigate future financial challenges effectively.
Do we have data on that?
We do. The OECD's PISA assessment, that's the Program for International Student Assessment, gives us some sobering numbers. In some G7 countries, like Italy, for example, about 20% of 15-year-old students lack even basic proficiency in financial literacy.
1 in 5.
Meaning they struggle with fundamental concepts and decision-making. And in other countries, think Peru or Brazil, that proportion jumps to over 40%.
Wow, nearly half in some places. That's a huge number of young people heading into adulthood without foundational financial skills.
It really is.
Does the PISA data tell us anything about who these students are? Like their home environment? Does socioeconomic status play a role?
It absolutely does, and it reveals a pretty clear correlation. The data connects financial literacy directly to socioeconomic status.
How so?
Financially literate students disproportionately come from families with higher levels of education and income, and often from homes that just have more books available, which is often used as a proxy for a resource-rich environment.
So a student's home environment, their access to resources, maybe even the financial conversations they hear or don't hear, plays a big role.
It seems to. It highlights a potential equity issue right from the start, doesn't it? The playing field isn't level when it comes to acquiring this knowledge.
That immediately makes me wonder how much this individual lack of understanding ripples outwards. I mean, it can't just be a personal problem stuck within individual households, can it?
No, absolutely not.
Does financial literacy have a broader kind of macroeconomic impact that affects all of us?
That's a crucial next step in understanding this, and the research emphatically says yes, it absolutely does. Beyond the personal struggles or successes of individuals, financial literacy has profound macroeconomic implications.
Okay.
It influences everything from how effective global financial inclusion initiatives are,
Right. Getting people banked.
to the very success of government policies and how citizens engage with them.
Okay, let's start with financial inclusion then. There's been this massive global push, especially from G20 countries, to get everyone access to basic financial services.
A huge effort.
But even with that push, getting people accounts, for instance, are they actually using these services effectively once they have them? Or is there still a gap?
That's precisely where financial literacy becomes critical, and often, it's the missing piece. Get this. The World Bank Global Findex data, cited in the sources, paints a stark picture. As of 2021, a staggering 1.4 billion adults worldwide.
1.4 billion.
Billion. That's nearly a quarter of the global adult population are either unbanked or lack even a basic financial account.
It is an immense number.
Yeah.
Just fundamentally outside the system.
It represents a significant chunk of humanity without access to fundamental financial tools.
And what are the main reasons people give for being unbanked? Is it just about not having a bank branch nearby, or are there deeper reasons?
It's not just about physical access, though that can certainly be a factor in some places. A significant number of these individuals cite lack of help or being uncomfortable using an account as a primary reason.
So it's about confidence and knowledge?
Exactly. Consider developing countries. A striking 64% of unbanked adults reported they couldn't use an account at a financial institution without assistance.
Wow, nearly 2/3 felt they needed help.
And this proportion is even higher among women and other vulnerable groups, highlighting that confidence and knowledge gap really clearly.
So it's not enough to just open an account for someone. They need to feel capable and confident using it. Otherwise, it just sits there, useless.
It becomes a dormant asset, exactly.
That reminds me of India's big Jan Dhan Yojana program, where millions of basic accounts were opened. Did those accounts actually get used consistently, or did they face similar challenges?
That's an excellent connection, and unfortunately, yes, the challenges were indeed similar. While the program successfully opened a huge number of accounts, the data revealed a significant issue. Many remained dormant or saw very little activity.
And the reason?
Well, approximately 30% of those inactive account holders specifically said they didn't feel comfortable using their account by themselves.
30%.
And similarly, in a study across 25 sub-Saharan African countries, 31% of mobile money account holders, a technology meant to increase access, needed help to use their accounts.
So these aren't just abstract numbers. These are real people who have a tool, but they lack the confidence or the know-how to actually use it effectively.
Precisely.
These numbers really drive home the point that basic financial access isn't the whole story. It's about effective inclusion.
It has to be effective inclusion.
So what's the clear opportunity here then for financial education?
Well, these data clearly highlight a massive untapped opportunity. By strengthening financial literacy, we can directly empower individuals to use these basic financial instruments more efficiently, more effectively.
Turning an open account into an active tool.
Exactly. A tool for managing money, saving for the future, making transactions safely. It means people can genuinely participate in the financial system, maximizing the benefits, minimizing the risks. It moves beyond just ticking the box of inclusion to achieving genuine empowerment.
That's financial inclusion. But you also mentioned financial literacy influencing policy and citizenship. How does a population's financial understanding impact, say, the successful rollout of government economic reforms? Things which are often complex and politically tricky.
This is where some other research cited in the editorial offers really fascinating insights. Many significant economic reforms, especially those involving public finances like Social Security or pension systems, inherently involve a trade-off, right?
Yeah, usually some pain now for gain later.
Exactly. A sacrifice today for a perceived future benefit, like raising the retirement age means working longer now for the promise of a more stable pension system down the road.
Right.
The challenge is, if citizens have low financial literacy, they may fail to fully appreciate those crucial future benefits. Or they might even misunderstand the fundamental workings of government budgets, how institutions like pension systems are actually structured and funded.
So they might actively oppose a necessary reform simply because they don't fully grasp the long-term positive impact or the underlying reasons why it's needed in the first place.
Precisely. That could lead to political instability or just prevent good policy from happening.
Yeah, you see battles over pension reform all the time.
It's a common political fight, even when governments are facing demographic realities like people living longer, fewer workers per retiree that put existing systems on unsustainable paths. Improving pension literacy is absolutely crucial here, not just for individuals to plan their own retirement better,
Which is vital in itself.
especially for women who often face unique challenges. Longer lifespans, maybe lower labor market attachment due to caregiving, often lower wages, all of which can jeopardize their retirement security.
And is pension literacy generally low?
Sadly, yes. It remains very low overall, and particularly among women, which creates significant societal vulnerability down the line.
That makes complete sense. And what's really fascinating here, you mentioned the sources suggest financial literacy can actually make it easier for governments to implement these tough reforms.
Yes. This is a really interesting finding.
Potentially even making voters less likely to, punish them at the polls for making hard choices. That's a profound political implication.
It really is. What's fascinating is exactly that. There's promising evidence suggesting that populations with higher average levels of financial literacy are indeed less likely to punish governments for implementing necessary economically sound reforms.
So a more informed electorate can make more nuanced judgments about complex economic policy.
That seems to be the implication. Understanding the long-term societal benefits over maybe immediate personal costs, that's a significant positive for stable governance.
And it goes beyond just pension reform, right? The paper talks about financial literacy fostering better citizens and more educated voters. What does that mean in practical terms?
Well, it means financial literacy can help individuals engage more critically with public policy in general.
Okay.
It can make them less susceptible to something called fiscal illusion.
Fiscal illusion, what's that?
It refers to voters maybe failing to accurately estimate the net cost of, say, tax reductions.
Like not realizing a tax cut today might mean more government debt tomorrow or cuts to public services.
Exactly, or not fully grasping the trade-offs involved. By enhancing this fundamental understanding of public finance and trade-offs, financial literacy can even positively impact electoral participation.
Leading to a more engaged and informed citizenry.
Which is a powerful outcome for the functioning of any democracy. It's really no wonder that, as the editorial notes, over 80 countries now have or are developing national strategies for financial literacy.
And often starting with a focus on pensions, which shows policymakers recognize its national importance.
Precisely.
Okay, so financial literacy isn't just about managing your personal budget. It's about making our economies and societies function better, fostering more informed citizenship. That's a huge takeaway.
He really is.
But let's shift gears a bit. If even basic financial instruments are hard for some people to use effectively, then more complex ones must present an even bigger challenge.
Absolutely.
The sources specifically highlight mortgages. For most families, their home isn't just a place to live, it's by far their biggest asset. So mortgage choices are critically important.
They absolutely are. And poor mortgage choices, as we saw so dramatically during the 2007-2008 financial crisis, can be a major source of financial distress for families.
Leading to foreclosures, instability.
And in aggregate, they can ripple through and destabilize entire economies. There's a paper cited that offers some fascinating insights into how people make these huge decisions, specifically looking at framing effects.
Framing effects.
Yeah.
That sounds like psychology meeting finance.
Yeah.
What does that mean when you're taking out a mortgage?
It refers to how the way information is presented or framed can subtly yet significantly influence how you perceive it and the decision you make.
Okay.
The researchers designed an experiment where people were asked about their comfort with home loan amounts. Some saw the loan framed as a single lump sum debt, $300,000 to be borrowed.
Right, the big scary number.
Others saw the exact same financial obligation, but it was framed as equivalent repayment streams, maybe monthly payments of $1,500.
Ah, the smaller, more manageable sounding number?
Exactly. The study wanted to see how just that difference in presentation affected their comfort levels and their understanding.
So, the hypothesis is, if a loan is presented as just $1,500 a month, it feels less intimidating than seeing it as the $300,000 debt, even if they're mathematically the same.
Precisely. A classic cognitive bias. And their findings bore this out. Borrowers were actually less comfortable when loans were framed as lump sum debts compared to repayment streams.
Interesting.
And what's more, they were surprisingly less adept at translating those monthly payments back into the equivalent total debt.
So they couldn't easily connect the monthly outlay to the overall big picture.
That inability to mentally connect the two is a critical skill gap. The study also used the big three financial literacy questions, covering basics like interest rates, inflation, risk diversification.
To fundamental.
Essential for understanding any financial decision, especially mortgages. And what they found was quite telling. Less than half of the participants in their sample could answer these basic questions correctly.
Less than half. And these were people who had bought a house or were interested in buying one.
Exactly. People actively engaged or looking to engage in the home buying process.
That's truly startling. If even people right in the thick of it don't grasp in these fundamentals, it really underscores the literacy gap we were talking about.
It really does.
But how does financial literacy specifically change this? Does being more financially literate make you immune to these framing effects or cognitive biases?
Well, maybe not totally immune, but here's where literacy really shows its power as a counterforce. The research demonstrated that a higher level of financial literacy tends to make borrowers more cautious.
Okay.
And generally less comfortable with debt. Crucially, it also makes them less sensitive to framing.
Ah, so they can see through the presentation.
They're better equipped to see through how the information is presented and focus on the underlying financial realities, the actual cost, the actual risk, regardless of whether it's shown as a lump sum or a monthly payment.
They can connect the dots better.
Yes, and financially literate borrowers can also more effectively match their liabilities with their servicing burdens, basically making sure your monthly income can comfortably cover those payments. That's key for avoiding distress.
What about mortgage brokers? Do they help bridge this knowledge gap for consumers? Or do they maybe add another layer of influence?
Well, the research indicates that brokers generally do increase clients' confidence and probably improve their understanding of home loans, which is positive.
Okay.
However, the study also found that brokers seem to influence clients' comfort with debt, potentially making them more willing to take on larger loans than they might otherwise.
Interesting dynamic.
It suggests that while brokers can be helpful guides, financial education also empowers consumers to use those services to their advantage, right? To maintain that necessary caution and not get swayed into taking on more debt than they can truly manage or understand.
So overall, financial education can really reduce mortgage stress by making people more cautious and less susceptible to how things are presented.
Exactly. It's a huge asset for homeowners or potential homeowners.
Definitely. But speaking of complexity, let's talk about reverse mortgages. These feel like, as the sources put it, complexity on steroids.
Chuckles. Yeah, that's a fair description.
For listeners who might not be familiar, what exactly is a reverse mortgage?
Okay, so a reverse mortgage is a specialized financial product mainly for older homeowners. It lets them convert some of the equity they've built up in their home into cash.
Okay.
Unlike a regular mortgage where you make payments to the lender, with a reverse mortgage, the lender makes payments to you or gives you a lump sum.
And you don't pay it back until...
You aren't obligated to make payments back until you move out permanently, sell the home, or, well, pass away.
Right. And there's this key feature, the no negative equity guarantee, NEG.
Yes, the NAG. That's critical.
It sounds like a significant protection for the borrower, but it also sounds incredibly complicated.
It is a significant protection. It means the borrower or their estate is insured against the risk that the loan balance eventually exceeds the value of the house when it's sold.
So if house prices fall, the lender takes the hit, not the homeowner.
In essence, yes. It transfers the risk of falling house prices and also the borrower living longer than expected longevity risk to the lender.
Okay, but valuing that insurance must be tough.
Exactly. As the sources emphasize, the valuation of this energy insurance feature is quite difficult to grasp and compute for the average person. It involves intricate projections of future house prices, understanding your own survival risk, thinking about when you might sell or move.
Wow. Yeah, that's a lot of complex variables.
It makes it incredibly challenging for consumers, especially those with limited financial literacy, to truly understand the full price and the true value of these products.
So even more complex than a standard mortgage. What did the research on reverse mortgages show about financial literacy? Particularly since these are usually products for older adults.
Right. There's a paper cited that conducted an experiment with 55 to 75-year-olds in Canada, precisely the demographic often considering these. And their findings were quite striking. Over half of the eligible Canadians in their study, 55.5%, lacked basic knowledge of reverse mortgages.
Over half didn't understand the basics.
And similar to the other mortgage study, only a little more than half, 54.1%, could correctly answer those big three financial literacy questions.
So financial literacy is low, even among older adults, people who've presumably made financial decisions for decades.
It indicates that experience doesn't automatically translate into deep understanding, especially with complex products. It underscores that this isn't just a youth problem.
So what was the direct impact of financial literacy in this context? Did it make people more or less likely to take out a reverse mortgage? Or something else?
Well, the findings made it clear that literacy isn't just about increasing or decreasing the likelihood of buying something complex like this. Instead, it enables respondents to better evaluate and assess the true value of these products.
Oh, so it's about understanding, not just a yes-no decision.
Exactly. Understanding the intricate details, the costs, the benefits, the risks involved. This paper also reiterates a broader point that's crucial. Insurance, generally, is often a hard concept for households to understand.
Especially with complex risk calculations involved.
Definitely. It suggests we need more research specifically on how education can help people grasp complex risk scenarios and insurance products better.
That makes complete sense. Okay, so from something as foundational as a mortgage or even a basic bank account, we're now moving into what many consider the Wild West of finance, crypto assets.
Chuckles, the Wild West indeed.
These are certainly complex, notoriously risky, and ownership has grown incredibly fast, particularly among younger generations. What's driving this seemingly widespread adoption of such volatile assets?
Well, this brings us to a very interesting hypothesis, one you hear debated constantly. The fear of missing out, or FOMO.
FOMO.
There's a paper cited that delves into whether FOMO is a significant driver of crypto ownership, especially given the rapid, often really dramatic price swings we've seen. This study builds on behavioral finance, which basically recognizes that our emotions, psychological biases, social pressures, they all play a huge role in financial decisions, often alongside or sometimes even overriding pure rational economic thinking.
So instead of just cool, calculated investment choices, emotions like FOMO are a major factor here, especially with crypto.
That's the idea they tested.
How did they specifically test this?
They surveyed undergraduate students at the University of Western Australia back in July 2021. And the timing is important. It was during a period when both crypto and traditional stock prices had surged quite a bit, creating a perfect storm for FOMO.
Right, when everyone seems to be getting rich quick.
Exactly. They looked at FOMO alongside traditional factors like financial literacy and risk tolerance, seeing how they influenced investment intentions for both stocks and crypto.
Okay, and what were the key findings? Was FOMO really as big a factor as people speculate, especially for crypto?
It certainly was, perhaps even more so than many might guess. The study found FOMO plays a significant role in both current and future investment intentions for both stocks and crypto.
Okay, so it affects both.
But here's the really interesting part. The FOMO effects were largest for crypto and for future investment intentions. It was notably smaller for current stock investment. This strongly suggests that the allure of those rapid, almost unbelievable gains and that pervasive fear of being left out
Of the next big thing.
is a powerful, maybe even primary driver for getting involved with these newer, riskier assets, especially when people are thinking about jumping in next.
So FOMO is a much stronger pull for crypto than for traditional stocks, particularly when people are thinking about future investments. What about financial literacy and risk tolerance? Do they act as a counterbalance here?
Well, they do have positive effects for current crypto investment, but these effects were found to be quite small.
Okay.
And crucially, smaller than the effects of FOMO.
Wow.
This indicates that for crypto, emotional and behavioral factors can often dominate traditional financial knowledge. Now, when looking at future stock investment, financial literacy still had a significant, though small, positive effect. But for future crypto investment, financial literacy did not have a statistically significant direct effect.
That's a bit unsettling, isn't it? It implies that pure knowledge might just take a backseat to emotion with something as volatile as crypto.
It points to a potentially worrying trend, where rational understanding of risk might be overridden by the emotional pull of missing out on perceived huge gains.
Did financial literacy have any indirect effect? Maybe via FOMO itself, perhaps by informing it somehow.
It did, but it was a nuanced and generally small effect. Financial literacy was found to have an indirect effect on investment via FOMO,
Okay.
suggesting that FOMO isn't totally irrational. It has some basis in knowledge, though this link was robust for stocks, but only weakly so for crypto. Meaning for traditional stocks, being financially literate might make you more aware of the opportunity costs of not investing, maybe contributing to FOMO in a more informed way. For crypto, that link was much weaker. Interestingly, while FOMO was a positive predictor of risk tolerance, the effect wasn't really economically meaningful. It doesn't seem to dramatically change your overall appetite for risk.
So the authors looked at all this and considered whether FOMO is fundamentally good or bad. What was their take?
They actually maintained an agnostic stance, which is interesting.
Agnostic. How so?
Their argument is quite thought-provoking. They say, look, if non-participation in stock markets, especially for young people, is potentially a mistake long-term for wealth building,
Right, missing out on compounding.
then FOMO could potentially play a positive role by encouraging engagement where it might otherwise be lacking.
Huh. Never thought of it that way.
They suggest that interventions directly addressing FOMO might be useful for promoting engagement in both stocks and crypto, maybe channeling that impulse more constructively. But the core takeaway for you, the listener, is pretty clear. Promoting sound financial literacy is particularly important among the young.
To help them make savvy decisions about these very risky assets, such as crypto.
Exactly. It's about giving them the tools to critically assess things, even when emotions are running high, and to understand that an asset promising quick gains almost always carries outsized risks.
This brings us perfectly to the most hopeful and actionable part of our deep dive.
The power of financial education itself.
Right.
We've established literacy levels are low, the need is urgent. So, where and how exactly does financial education work to fix these critical knowledge gaps?
Okay.
Let's start with schools. We know PISA assesses 15-year-olds. Many countries are making financial ed mandatory. But does it actually work? Does it make a measurable difference?
It absolutely does. And the evidence is getting increasingly rigorous and compelling. There was a major meta-analysis cited covering programs across 33 countries on 6 continents. Huge scope.
Okay.
It found clear, consistent results. Rigorously evaluated programs do indeed affect both financial knowledge and, crucially, downstream behavior, what people actually do with their money later.
So it's not just ticking a box in the curriculum.
Not at all. And what's really remarkable is that these positive effects are similar across different age groups. It helps young and old, and they hold true across incredibly diverse countries and cultures. So it's a globally effective intervention. Foundational knowledge can change behavior.
That's what the evidence points to.
And specifically for high school students, what kind of lasting impact does it have after they graduate?
Well, other research cited focuses specifically on high school financial education. Their findings show that young people exposed to these programs are much less likely to have problems with debt as young adults.
Much less likely to have debt problems. That's a powerful, tangible benefit.
It really is. It extends well beyond graduation, suggesting that early education can instill habits that prevent future financial distress. It builds a more stable foundation as they start their independent adult lives.
That's a huge direct impact for the students themselves. But here's where it gets really interesting and, frankly, quite groundbreaking in the research. What about spillover effects? Can financial education given to students actually benefit their parents? It almost sounds too good to be true.
This is indeed one of the most innovative and important findings discussed. There's a paper from Peru, a country we noted earlier, has high rates of low student financial literacy described as very innovative.
Why innovative?
Well, first, its methodology. It was a large-scale, randomized controlled experiment. Students randomly assigned to get the education or not. That's the gold standard for research design, allows for strong causal conclusions.
Right, very rigorous.
Second, and this is crucial, they linked the study data directly to credit bureau records. So they had objective financial outcomes, not just what people said they did.
Real verifiable data on defaults, credit scores, debt levels.
Exactly, making the findings incredibly robust.
Okay, so what did they discover about the parents? Did the kids' education rub off?
The findings are pretty profound. In addition to helping the students, the financial education provided to the students actually helped their parents.
Wow.
Specifically, parents of low-income students.
What changed for the parents?
Among these poorer households, the parents' default probabilities decreased. They were less likely to miss loan payments.
Okay, that's huge.
Their credit scores increased, which means better access to financial products on better terms.
Also very positive.
And interestingly, their debt levels increased.
Increased. Is that good?
Well, the interpretation here isn't that they just piled on more unmanageable debt. It's seen as an indication of better access to and more confident management of credit, using it more effectively, maybe for productive purposes.
Oh, okay. So better access and use, not just more debt.
Exactly. And here's a truly striking finding. There was an important gender effect. It was mostly the parents of daughters who experienced these improved financial behaviors.
Parents of daughters specifically. That's fascinating. Any thoughts on why?
The paper doesn't definitively explain the why for the gender effect, but it's a really intriguing result that warrants more research. Maybe daughters communicate differently with parents about finances, or perhaps the education resonated differently depending on the child's gender in that cultural context.
Incredible. So a program designed for kids had a measurable positive impact on their parents' financial lives, especially in vulnerable households, and with this distinct gender dynamic. What are the broader policy implications here?
They're immense. These findings suggest financial education in school can be far-reaching and have important spillover effects, particularly for vulnerable groups.
So investing in kids' financial ed pays off for the whole family, maybe even more than we thought.
Exactly. It suggests that investing in the younger generation can have a significant, positive, multi-generational impact, improving not just the students' future, but the current financial health of their entire households. It points to a powerful lever for tackling financial vulnerability and boosting economic mobility from the ground up.
That's a really strong case for financial education in schools. But what about adults who are already out in the workforce? Is the workplace a suitable or effective place for this kind of education?
The sources indicate it's actually an ideal setting for reaching adults. The OECD even has a policy handbook promoting financial education in the workplace. And there are numerous reasons why it's beneficial, not least for the employers themselves. There seems to be a clear return on investment.
How do employers benefit directly? I can imagine financial stress among employees must impact productivity, maybe even retention.
You're absolutely right. Financial stress carries a hidden cost for businesses. There's works cited that offers a compelling, if maybe crude, estimate of this cost. A 2021 survey asked U.S. adults how many hours a week they spent worrying about personal finances, and crucially, how much of that worrying happened at work.
Okay, what did they find?
The findings are pretty startling. U.S. adults reported spending about 7 hours per week, on average, dealing with personal finance issues. And get this, over 3 of those hours were spent at work.
3 hours a week per employee just worrying about money while on the clock. That's a significant chunk of lost focus and productivity.
It really is. Now, contrast that with the most financially literate respondents in the survey, those who got over 75% correct on a financial knowledge index.
How much time did they spend worrying?
They reported spending significantly less time. About 3 total hours per week on financial worries, And crucially, only 1 hour per week at work.
Okay, 1 hour at work versus 3 on average. And what about the least literate?
The least financially literate, 25% or less correct. They reported a staggering 11 total hours per week worrying about finances.
11 hours?
And over 4 of those hours were spent worrying at work.
4 hours a week at work per employee lost to financial stress. For the least literate group, this is like a significant quantifiable cost.
It really does. You see a direct correlation. Lower literacy, higher financial stress, more time distracted on the job.
Did they try to put a dollar figure on that?
They did a compelling sort of back-of-the-envelope calculation. For a hypothetical company with just 30 minimum wage employees, say $15 an hour, working 50 weeks a year, financial education could potentially recover $22,500 of value per year for that employer.
Just by reducing the time employees spend worrying at work.
Exactly, and they argued this figure is quite conceivably greater than the cost of implementing many workplace financial wellness programs.
So it implies that scalable, low-cost financial education programs could actually generate a positive ROI for the employer.
That's the argument, especially for large employers who can benefit from these efficiencies at scale. It makes a clear business case for investing in employee financial well-being.
Yeah, it's a very clear business case. And how should these workplace programs be designed to be most effective, given that you have employees at all different life stages and with different needs?
Yeah, that's important. Other research cited provides valuable insights here. It notes that providing financial education right when workers are first hired is ideal.
Why again?
It helps both the employer and the employee understand and make the best use of company benefits, things like health insurance options, retirement plans, other compensation elements that can be confusing.
Makes sense. Get them started right.
Retirement planning is also uniquely crucial in the workplace context, especially with that big shift we talked about from defined benefit pensions to defined contribution plans like 401ks, where employees have much more responsibility.
Right. Helping them understand their 401k options, contribution levels, investment choices. But should it only be about retirement?
No, not at all. The research strongly argues that financial education shouldn't be limited just to retirement topics.
Why not?
Because other financial decisions employees make, managing debt, buying a home, dealing with unexpected medical bills, they all interact with their retirement planning. You can't really separate them neatly.
So a more holistic approach.
Exactly. Holistic financial education programs offered throughout a worker's entire life cycle are better suited to fit the diverse and evolving needs of a modern workforce. And offering programs well before retirement helps workers really harness the power of compounding interest.
Encouraging them to save early. Take full advantage of any employer match.
Which is essentially free money.
Right. It sounds like there's a lot of promise here, even if doing perfect randomized controlled trials is difficult in a real workplace.
Indeed. While those gold standard trials are challenging to implement in dynamic workplace settings, 2 decades of work in this field show much promise. Employees generally appreciate these programs, they rate them highly, they often report reduced stress and increased confidence.
And it could be good for the company, too, beyond just productivity.
Absolutely. Offering this kind of comprehensive benefit can also be a useful retention tool in a competitive job market. It shows an employer cares about their employees' overall well-being. It really seems like a win-win.
Okay, so bringing it all together then. After diving into all this research, what are the absolute core takeaways from this deep dive into financial literacy and well-being? What should our listener really walk away with?
Well, the papers highlighted in this journal issue consistently share a few powerful overlapping findings. First, financial literacy, while absolutely fundamental, is undeniably low globally.
And often just inadequate for the complex financial decisions we all face today.
Right. This spans everything from simply opening and effectively using a basic bank account
to expertly managing a huge commitment, like a mortgage, understanding intricate products like reverse mortgages,
and even navigating brand new, highly risky assets like cryptocurrencies.
And it's crucial to remember that this knowledge gap disproportionately hits already vulnerable groups, women, those with lower income or education, potentially making existing inequalities even worse.
That's a critical point. But the good news, the actionable insight here, is that financial literacy truly matters. It offers profound, tangible benefits for everyone.
It demonstrably helps people make savvier financial decisions,
including being less swayed by how information is framed,
better understanding the complex details they're given,
grasping the nuances of things like insurance,
and just feeling more comfortable and confident using even basic financial tools.
Exactly. In a nutshell, financial literacy fundamentally improves your individual financial well-being and your resilience. It acts as a buffer against economic shocks and uncertainty.
And we've seen its effects really extend far beyond just the individual household. They ripple out.
Right, influencing broader societal issues like fostering greater financial inclusion, making sure people can actually use the services they have access to.
Enabling the successful implementation of crucial, sometimes difficult economic reforms.
And even strengthening how democracies function by creating a more informed and engaged citizenry, less susceptible to things like fiscal illusion.
It seems every financial instrument carries potential costs and risks, doesn't it?
Yeah.
And you need a basic level of knowledge just to navigate them well.
Precisely. And when instruments become particularly complex or risky, like those reverse mortgages or crypto assets, financial literacy shifts from just being helpful to being a fundamental requirement for informed use. It has to work hand in hand with adequate financial protection and regulation.
So as we look to the future, new trends are constantly emerging. Rapidly evolving digital financial services, AI-driven financial tools are coming online.
The whole field of sustainable finance is growing.
Even more intricate investment vehicles are being created. It really makes you wonder, doesn't it? What new financial literacy challenges and maybe opportunities will emerge for us to grapple with?
That's the big question.
And maybe the question for you, our listener, is how will you continue to grow your financial knowledge to confidently navigate this ever-evolving, increasingly complex financial landscape?
Something to definitely think about.
Thank you for joining us on this deep dive.